for every $1 million, let's say in basis, okay, a cost segregation study in year one is probably going to generate around 300 grand.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, excited to have Terry Judge. Terry, how are you doing today?
I'm doing great, Todd. Thanks for having me.
Absolutely, man. So a little bit about Terry. He's with Core Advisors, the owner of Core Advisors. And well, I'll just let you explain what you guys do, but we've used your company deals past, been very happy with the results and continue to take advantage of kind of the tax code and situation. So let's dive in. What exactly is Core Advisors? What do you guys do? And then I'll come with some questions.
Yeah, absolutely. So Core, we started this, I started this 16 years ago, 2006. We launched it, and, we just saw a big gap between the accounting world and the IRS and then the client. And the client would be somebody like you, Todd, that, tax planning is so important around real estate. And we just saw this huge, just hole in between the client and the IRS and what's available. So, we started this thing we went down this road of, cost segregation. And again, it kind of found me and I started to look into it. I'm not an accountant by training, but I was just so intrigued. And, essentially it's just this powerful tax strategy. I would say it's probably the most powerful tax strategy, in the United States.
Well, especially for real estate, right? I mean, there's no question for real. Yeah.
No question for real estate investors, but, so Core started down that path and launched in 2006. Like I said, we started kind of doing seminars for CPAs. And what we learned quickly is that I would say back in the day, and this was 2006, no mid-sized to small CPA firms were involved in this, didn't understand it. We're not offering this out to their client. Yep. And, we said, wow, what an amazing, if we could create this bridge, this gap, like I said, between, the IRS has billions of dollars available to stimulate whatever they want to stimulate. In this case, it was commercial real estate development and investing, and then offer this as a service and really teach and educate CPAs, and that's what we did. So we started down that road. I started speaking on the topic, and slowly but surely, we started gaining traction and we started to expand nationally. And, to date, we've done probably close to a couple billion now in savings for our clients. Wow. I think it's 1.5 billion on our website, but we think we've surpassed that last year. Yeah. And, it's just been a great run. We've got a great technical team. I think that's really where the magic, really happens, is the experience. When you're dealing with the IRS, it gets a little tedious. And that's why most CPAs do not do this, because it's a blend of engineering, legal, and tax. Obviously, CPAs have a very good handle on depreciation, but when it comes to the buildings, how buildings are built, and there's been over 300 court cases and IRS rulings that drive cost segregation. A lot of people don't understand, how it works, why it works, what you can take, what you cannot take. And so therefore, we've built the company to do these forensic, engineering analysis, very granular, where we can account for every nickel that somebody like yourself spends on a building and or the rehab. And so our end result, or our end deliverable, is a very detailed analysis of every component. And then we can then accelerate and break apart all these components in the building that really qualify for much shorter life, which makes sense because things wear out. Things don't last for 27 and a half years inside of a building. And some people say, well, is this aggressive? Is this kind of the, pushing the envelope? And my answer to that is no, it's in the code. It's been in the code since 1969.
Wow.
And it's gone through layers and layers and changes. But for whatever reason, Democrat, Republican, all the presidents over the last, few decades, it's been enhanced. So when people cost segregation, there's a lot of different enhancements that, we can touch on. I'm excited to speak at your conference coming up in May. We're going to really break it down, and I'm going to kind of hopefully go a little bit more in detail on all the nuances on, renovations, disposition, when you exit the property, what happens if you don't do a 1031? What happens when you combine it with a 1031? All of why is it attractive for a general partner? And then why is it attractive for all of the limited partners that come into the deal? And I think there's such a win-win. And thank God today, I'm starting to see it be more proactive versus reactive. Even really up to the last few years, Todd, it's been almost like an afterthought. And I know you guys are very proactive, very efficient when it comes to tax, because it is a big portion of the ROI. Upwards of, it can be ordinary income rates, or, it depends on tax brackets. It can go all the way up to, 37%.
Yep.
So it's all timing as well, but, and people say, well, what qualifies? And again, I'm just you can interrupt me, but I'm just, any property. So for somebody listening to this, and you're just now getting into, you're going to buy your first duplex, or you've got some smaller multifamilies, or you're growing quickly, anything over $500,000 qualifies now. It used to be about $1 million. Now we're helping people doing their short-term rentals. I mean, we're doing a lot of short-term rental properties, right? And some of these short-term rental properties are $1.5 million.
Right.
And they're rehabbing them, so it's critical on adding cost segregation and working with a reputable company that makes sure that they have the engineering capabilities, so you can defend if the IRS ever came looking or scrutinizing or questioning, or if something else in your business caused an audit. You want to make sure that all the T's are crossed and all the I's are dotted, and you're working with a company that can support you if that ever was the case. It's very minimal, but it is a thing.
Let's break this down. Just I want to make sure everybody that's listening really understands what they're listening to, right? So first, most people know when you buy real estate, you can depreciate the asset. The government says that over X period of time, 27 and a half years for like multifamily, single family, and 39 years for other commercial, think industrial, think retail, that in that time period, let's go back to an apartment building. In 27 and a half years, the government says it's worth $0, not the land, just the building. The building's worth $0. So Core Advisors is coming in and they're going, well, yeah, the government says 27 and a half years, but the government also says this part only lasts 5 years and this part lasts 10 years and so on. That's correct, right? That's what you guys are essentially doing. You're picking apart a building.
Exactly. Yeah. So the shelf life of a lot of your interior, according to the IRS, has a 5-year life, and all of your exterior, which will be all your land improvements, has a 15-year life. But if you and I buy a building for $1 million, that original purchase, including the land, is going to be in, let's say it's an apartment building, it's all going to be in 27 and a half year long-term straight line life, right?
So if the building's worth $800,000 and the land is worth 200, we would just take $800,000, we divide it by 27 and a half years, and that's how much it loses value per year. So that's how much we can reduce our taxes by per year, right?
That's the straight line method, right?
Straight line method.
Right across the board. That's what most CPAs in the country are going. That's how they depreciate your building. Basically, there's two pathways in the tax code. There's the straight line method, and then there's this accelerated method that we're talking about today.
Yeah.
And therefore, we can go in, like you said, Todd, and there's hundreds and hundreds of components. Obviously, in your interior, if you think about the interior of a building, especially like a multifamily property, you've got portions of the plumbing, the wiring systems, fixtures, drop ceilings, carpeting. There's all kinds of permanency rules that we as an engineering firm go in there and look at, because the IRS says, okay, well, if you remove something from the interior, how much damage does it cause? There's a whole permanency revenue rulings based around what you can move and what you can't move based on damage. So we have to kind of assess that. Yeah, and then when we look at the exterior, swimming pools, curbs, landscape, underground drainage systems, fencing, all of that stuff, curbage, outdoor electrical, all is part of our study that we can now pluck out of the 27.5 years. We put that in either a 15-year life, which I just said exterior, and then all of your interior, even non-load bearing walls, stuff like that. If you're doing rehabs, all that stuff is we put it into our analysis in our studies and break it all apart. And certain components have to stay in long-term life. Okay, so it's not like that, and that's the value of bringing in an engineering firm like Core. Again, it's going to be this forensic engineering analysis. Certain components have to stay in 27.5 year life. So we typically find about 30% ish on an average is from that purchase price. So like you said, Todd, so if we have $1 million property, we're going to take usually about 15%, but in this case, let's just say 200,000. We're going to move that to land, and then land does not depreciate. And then we take the rest of the building and about 30% of that number. Okay. So about 240 grand is going to be written off in year one because of bonus depreciation now, which is kind of a new and improved little caveat that back in the Trump days, he threw this in there and added a whole nother level. And the investment community said, oh my God, you mean our entire down payment basically can be written off, essentially. And people can get this depreciation even as a passive investor.
And that's going away. Is that correct? That
it's going to phase out. So this is the last year you can get 100%. So we're going to have a busy year.
Yep.
And then it goes 20%, 20%, 20%. It just keeps fading through 2026.
Yep.
So that's, and then, we'll see what happens. If it's cost seg, it's still going to be great, even if you don't have bonus depreciation.
Yeah, cost seg is still there. That's not phasing out. It's just the bonus depreciation, which is a nice benefit, of course, especially coupled with cost segregation. But cost seg is still going to be available, so it's not like you guys are going away.
No, just the bonus depreciation is going to start fading out a little bit. But we'll see.
So you create this big engineering report. Do you send people to the properties?
We do.
Okay. Send people to the properties. You guys come with this big engineering report. Where's that go? Like, what does the CPA now have to do? Because you're not the CPA. You're just saying that this is broken down like this. How much extra time and effort does this add onto the CPA? How much will my CPA bill go up by this?
So if it's a property that's just gone into service, so let's say it's a newly constructed property.
Yep.
Or it's a new acquisition, nothing. The CPA literally is going to take our work and just incorporate it into the tax planning, putting in adding the depreciation into their tax return.
So you give them a very basic, here's what it is, boom.
Yeah, we actually even redo the depreciation schedules here in my office. So most of the accounting work is completely finished, and we just hand that off to the CPA. The report actually just it's not submitted to the IRS. It's just a report that's going to sit on the shelf. And that is for our audit defense. If that ever came, we would be able to, show the IRS field examiner, here's what we did, why we did it. Here's why we took, 15 or 16% of the electrical. We're going to detail it. We're going to cross-reference it to case law and in our report. So it just really builds that audit defense.
So if you want to play some Russian roulette, you could just come up with a number, give it to the CPA, and hope you never have the IRS sniffing around.
Yes, exactly.
Of course, one day they will, and then it's not going to end well.
Like robbing a party store, man. One of the days you're going to have, no brainer. You're going to get out and no one's going to see anything. And the other day, man, you're going to walk right in, the cop's going to be right there, front door.
Hey, the North Star Real Estate Conference is back. It's May 2nd and 3rd, and this year it's a bit different. We're going to be hammering in on multifamily real estate, and we're going to show you asset management, value add strategies, raising millions of dollars through syndication, and how to find those hidden gems in today's market that are just so tough to find. And one of the biggest things I'm excited to bring you is industry experts that you're going to be able to put on your team so you can hit the ground running day one. So join us May 2nd and 3rd at the North Star Real Estate Conference. I look forward to seeing you there.
So, but now just to add to what I was saying, so if you go back, so let's say it's an older property, a lot of people don't know this. So if it's an older property and you've owned it for like say 5, 6, 7, 10 years, and you've never heard of a cost segregation study, you never did a cost segregation study, and all of a sudden you heard about it, well, we can go back in time. We as core, and I'm just saying, the CPA doesn't really have to do much. Again, so we're going to do the 31, it's called the 3115. It's a kind of a technical form that triggers the release of the depreciation from the day that they purchased it without amending tax returns. So it's an automatic one-time consent. And then that missed depreciation gets carried forward into the current tax year. And then that still has a 20-year carry forward ongoing. So, and again, so then we would then just do that 3115. We send that off to the CPA. They're going to take our numbers. We redo the depreciation schedules. They can put, they take our stuff and put it into their software, and then off they go. So there's not, the only time that, and it's rare, that you can amend if you wanted to and file for a refund back in a year that you, let's say you crushed it, and all of a sudden that one particular year is going to get, an extra couple $100,000. You can go through that, but I would say 98% of our clients just file the 3115. They're going to get the depreciation anyways. They're going to offset that income, and then it carries forward. So that's the cleanest way for the client and the CPA.
Interesting. You're doing a big renovation to a project. Is it best to wait until the renovation's done? Is it best to do the cost seg right away? How does the renovation work into the whole relationship there?
So yes, the best time to do a cost seg, I would say get us in there before the renovations begin. And the reason why is that we want to know what's going on. What's that?
Day one, right away.
And there's a reason for that. So we do the as-built. Okay. We want to know what's there. We're going to cost seg all that stuff out. Okay. Yeah. Then there's what's coming out if it's a major rehab. So you're going to be ripping out all kinds of stuff, electrical, walls, or just you're going to be redoing stuff. The cabinetry is coming out, all that stuff. There's something called disposition. So some of those assets they still have lives on them, and we can kind of calculate what that is. And so you get some disposition benefit on the tear out. And then once it's finished, we come in and once you guys send us the final change orders, we can finish the final cost segregation study. So we really look at it as in two phases. We do the kind of the as-built / kind of what's going to be coming out. And if those count as personal property, and instead of throwing them in the dumpster, there's still values left. So we calculate what those values are left on those and figure out that's going to be more tax savings as well. And then on the final change orders, the final renovations being completed, we want to stay in the loop, and then we'll finish those out once we get the final change order. So that the timing of getting us in there before than later is the best.
Okay, got it. You may not be able to answer this because, of course, everybody's tax situation is different, but maybe you can give us even a ballpark, and I know every property is different. But let's just say you buy a property, $1 million, and you end up putting down a $250,000 down payment. You do cost seg. What could you expect as far as depreciation savings in that, first, let's call it year or so, versus if you just did regular depreciation?
So rule of thumb to keep it simple. So let's just go with this. So for every $1 million, let's say in basis, okay, a cost segregation study in year one is probably going to generate around 300 grand. So for every million, now obviously we're backing a little bit out of land. I'm just keeping it simple and round numbers. So I'm just using a million. So let's say it's 1.2. We put 200,000 in the land. We got $1 million left in basis. We come in and we cost seg that out. You can expect with bonus depreciation, you're going to get roughly around 300 grand in gross depreciation off the top.
Got it. So,
Yeah.
so you could, if in theory, if you had a gain from a property, you sold it $100,000, you could maybe even depreciate all of your gain from that previous sale. And so you don't have to pay necessarily, just pushes it forward, obviously, but you don't have to potentially pay those capital gain taxes because you did a cost segregation study with the bonus depreciation.
Yeah, exactly. Like some people just don't want to do the 1030. 1031 is great. You can defer. It's similar to cost seg, but let's just say the timing does not work out. You don't want to overpay because you're stressed. You only have 180 days. But you can do the cost seg, and you can use the cost seg depreciation to offset income that you made from another property. So that's powerful, and that's the tool that you want to be aware of when you're sitting on past income from another transaction. You can use the beautiful thing about cost seg is that you can continue to do this on every property. As you exit and go into the new property, you're cost segging. You're constantly creating losses, and you're using those losses against income from a previous sale.
Why is it attractive for me as a syndicator? I syndicate, I've got LPs, limited partners. Why is it attractive for me to do a cost segregation not for me, but for my investors?
So the investors can put in, let's say, 100 grand and potentially could see, 50 to 60% of that come in on their K1s. Now, if they're not an active real estate or a real estate professional, you can only take, your passive income against passive losses. Yeah. So it's a 1-to-1 ratio as far as the property that they're investing in. However, it has a carry forward. So every single year that benefit is going to carry forward. So you're always going to have a loss going forward, until that property is sold. So that's the why. And a lot of people are that, if you're like, as your network, your world, you got GPs investing with you that just want to be an LP because it's a great deal, because they're they have their real estate professional. They can then use that depreciation to offset income from other sources. And that's the beautiful thing about that. That's a whole nother conversation, but yeah, so I think that's why, syndicators out there, the savvy ones, are building cost seg into their perspectives and showing how this can work it's beautiful. So you get the income, but you really show a loss on your taxes via your K1.
Yeah, I mean, I love it as a real estate professional. It certainly is catered towards real estate professionals that can take full advantage of it. The passive investors that aren't real estate investors that can't take full advantage of it's attractive, but not nearly as attractive. I passively invest in other real estate deals outside of my own in order to get more depreciation myself. And I think a lot of people do that. There's got to be some cons with cost segregation. Why wouldn't I want to do a cost segregation? What are maybe some limitations or some reasons why you would ever tell somebody, hey, maybe this isn't the best tool for you?
There's not many. I mean, I've been doing this for 16 years. The only time I would say, and this is just a timing thing. If you bought a piece of property, it's vacant, you're not going to have you're going to be doing a major renovation. you've got losses coming in from everywhere else, and maybe you just don't need it. You don't want to pay a company like mine. Maybe you just don't need it for that particular tax year, but maybe once it goes into service and you're starting to cash flow, then obviously we do the cost seg. The only other, and then the other reason would be maybe you're going to get in and out of the property, you're going to flip it, and you're going to maybe sell it within a year. And we would just say, no, our whole time, because you're going to have recapture, and it's going to be a wash. It's not worth your time unless there's you don't care. You're going to flip it. And that's what that was. Sure. It was designed for the flip, and you're just going to pay tax on that gain, and it is what it is. But yeah, I think those are really the only, reasons. If, our kind of rule of thumb, Todd, is about 3 to 5 years hold time, because you really want to maximize that time value of money. Now, even on the recapture, you could be paying 25% capital gains versus ordinary income. It depends on your tax bracket. So it's sliding, normal capital gains is at 25. Now recapture, because the IRS is going to want some of that depreciation back, and they do tax it at ordinary income. Okay. Now here at Core, we have a kind of a method that we can show that those assets have zero balance, and we book it as a bandit on the depreciation schedule. So there's a way for proper planning. I don't want to get into that right now. That gets a little, but again, we can work with your CPA, and there's a way to kind of mitigate. I'm not going to say eliminate. I'm going to say mitigate the recapture even on a shorter time frame. I would say if it's under a year, not good. If it's kind of, you're getting into the 2 and 3 years, and you're going to exit, we can actually run recapture analysis now and show, kind of what ifs. You bought it here, you're going to sell it here. What's that ramification look like based on, I think maybe effective tax rate is this, blah, blah, blah. So again, but at the end of the day, there is no reason. But if you really look at the situation, it most of the time, it doesn't make sense not to do it at this point. It's almost like it's almost become the, kind of an appraisal. You have to, if you're going to get a mortgage on a property, you got to have an appraisal. Same thing here. Even if you're going to buy a property, you really should have a cost segregation study.
What if I'm buying a single family or duplex, and it's, you're in Detroit, like I'm buying a single family for, or duplex for $100,000, $150,000, $200,000. Does it make sense?
Our rule of thumb has been about 500,000 or above. So we're doing a lot of single family like portfolios. Like we just did one for 26 homes. We bundle it up, and the savings were significant. Probably, I think it was almost 500,000 just in tax savings. They owned them for a little bit, and these are smaller single family, but when we added them up, it made sense. So I would say one-offs, if you want a couple homes that are 100 grand, probably not economical for either party. But I think if you have 400,000 to 500,000 in basis, adding them up, and we'll do them as a kind of a bulk. In bulk.
So, yeah, that's what I was going to say. So now I've, some people that are listening went, well, most of my properties are, 400,000 or less, but wait a second. Now, if I've got multiple, so let's say I bought one in 2010, and I bought one in 2011, 12, and 13, and you add those all up, and I've got 30 properties, or even maybe it's a bit more recent, whatever. Over the last 5 years, I've bought multiple properties. I got 30 of them. Would it make sense to go, hey, I'm listening to this. I'm listening to Terry right now. Could I send him my whole portfolio and do a cost seg on that whole portfolio that I've been buying over the last 5 years? Does that make sense?
Oh, it makes 100%. I mean, it makes total sense. Yeah.
Even though the properties are worth 200,000 a piece, if we bulk them together, now it starts to make the financial sense to go through the.
It does. It totally does. Yeah. And like I said, we're working on one right now at 26 homes. We ran the benefit analysis, and they send us over, let's say, an Excel spreadsheet. It has a purchase price, purchase date, renovation costs or approximate, and we take all that information, we put it into our system, and spits out this kind of the savings analysis on the total package. And it's surprising. You're like, oh my God, how do these little houses, but they add up, and the benefit adds up. So again, I would say anything from, if you take all the properties, let's say there's 10, 20, 30, even if they're $50,000 purchase prices, you add them all up. If it's over 400 grand or 500 grand, I would say we don't charge one nickel to do the kind of the preliminary review. And then so then you've seen our benefit analysis. They're very detailed, kind of shows near-term cash. It already has bonus depreciation calculated in there. It's got the land and everything broken out. So you can really see, and maybe share that with your accountant, and you can make an informed decision whether this makes sense, or not, based on those numbers. So that's the first place to start. I always tell people, it doesn't hurt to at least look at your portfolio and let us give you some advice on that stuff. And we're going to look into your rehab costs on those as well. And you'll be surprised, that's some additional tax savings on that as well.
Love it. Love it. Terry, what else do we need to know, if anything, about Cost Seg, about how do we save a pile of dough? Because, man, taxes are like between like property taxes, sales tax, all those taxes that you add up together, at least I can take advantage of some of them. They're the most expensive part of owning and controlling assets. So what else do we need to know, Cost Seg, and then we'll wrap up.
Okay. So one, I would just say, I would reiterate, if you have properties, you're looking to close on a property this year, you're getting into the business, you're a little fuzzy about what we're saying because it's the first time you're hearing it, or even the fourth time you're hearing it. At least I would say get a benefit analysis prepared, and just have that preparation going into 2022. The other thing I'll tell you, I'm a passive investor. But for me, because I have my W-2, my job, my core, my business, I was looking into short-term rentals, and that's what I'm going to get into, because they have something called material participation, where I can qualify technically as a real estate professional, keep my day job, as long as I dedicate about 100 hours into the property. You then can now use that. It's non-passive income. I can use it to offset my active income, believe it or not. And I'm like, oh my God. So there's always new things out there, but that's kind of a big thing right now. And for those of you that are listening, so number one, we're doing a lot of cost seg on short-term rentals. Number two, the tax treatment for short-term rentals are hugely favorable for people that have W-2 jobs. So look into that. Happy to share more info. Reach out to me. And there you go, Todd. That right there could probably save people, I can't even tell you how much, in taxes.
Yeah, I love that. That's great advice. And if you want to know more, of course, about Cost Seg, you should join the North Star Real Estate Conference, which you'll be at. You'll be hammering us with all kinds of goodies there. Terry, I got a couple last questions. I always ask every listener before we wrap up here. What's a favorite book that you can recommend to a listener? Business, real estate, tax, whatever.
Geez. I just started reading again, The Millionaire Next Door. And wow, that's been really eye-opening. I read it. I don't know if I read it probably, I don't know, maybe 10 years ago. And I just took it off my shelf about a week ago, and I'm starting to dig back into that book. It's pretty amazing.
Love it. All right. What are your 3 pillars of wealth creation?
I would say, well, the first pillar is keep my income higher than my expenses. That took me a little while to learn, to kind of live below my means, but still have a good lifestyle.
Yep.
I think the other one would be just knowledge, again, constantly learning, podcasts, learning about short-term rentals, that kind of stuff. And then third thing I've always known, and someone taught me at an early age, just, I try to surround myself with people that, like yourself, that are already, way ahead of me as far as my real estate investing, and just learning about, I've hired 2 different coaches this year, and I continue to plug in. So I think that's just the learning and the knowledge it elevates so much quicker if you're committed to constantly learning new stuff, getting on different podcasts. And I just launched my podcast, so I can't wait to bring you on my show.
Yeah.
And I get to ask you some key questions. on what's been impactful for you. But so I look forward to that as well.
Terry, I love hearing a guy like you who's been in the business for a while. You're not a, even though most people looking at you probably think you're about 2022, you're not 2022, and you're hiring people to help you to grow your business, to help you learn new things, and you're still learning. I love hearing from people who've been successful in business and yet are still challenging themselves and still trying to grow by hiring mentors, by joining masterminds, by doing things like that. So that's awesome. I just love hearing that and love seeing people always wanting to take their business to the next level. So congrats on that.
Yeah.
Tim.
Yeah. I mean, I think you and I kind of connected at a mastermind. I mean, I knew I knew of you. I didn't really know you that well. And then you and I got to connect and actually shake hands and have a beer at a mastermind.
Yep.
And now we're doing business together. So it's just, I think that's just that's got to be a pillar for everybody as far as that goes.
Love it. All right. So Terry, last thing, how can people get in touch with you?
Yeah, the easiest way, I would just say, just email me. It's the best way. I'll respond usually within the next day, or the day of. It's Terry, just my name, Terry Judge, and then the name of the company, coreadvisors.net. And feel free to reach out. Love to help.
Awesome. Terry, again, appreciate you being on the show. Thanks so much. Man, we don't talk about this topic enough. So I love hearing about it. I know our listeners got a ton. Well,
I will see you, sir, at the event coming up
soon.
Beginning of May. Very soon.
God. Yeah. All right. Take care.
All right, man. Thanks for having me.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.